Is the stock market a roller coaster of emotions right now, or what? One minute you're celebrating record highs. The next, you're bracing for a potential dip. That pretty much sums up the global market situation today, as investors navigate a complex landscape of promising earnings reports and nagging economic concerns. It's a tug of war between optimism and caution, and the outcome is anything but certain. Earnings versus valuations. The big balancing act. The heart of the matter lies in a fundamental question. Are current stock prices justified by company performance? We're seeing some impressive earnings coming in, but many analysts believe that the market has already priced in much of the good news for the year. This means that further gains might be limited, and we could even see some pullbacks as investors take profits. Take Wall Street, for example. The Dow Jones Industrial Average defied gravity, soaring to an all-time high of 46,924.74, a jump of 218.16 points, or 0.47%. This surge was fueled by stellar earnings from giants like General Motors, up a whopping 16% after boosting its guidance. Coca-Cola, a refreshing 3.8% increase thanks to strong demand and expansion in India. And 3M, a 6.3% leap after crushing earnings estimates. Even defense stocks joined the party, with Raytheon and GE Aerospace enjoying significant gains. Danaher and Warner Bros. Discovery also posted strong gains amid robust Q3 results and sale rumors, respectively. But here's where it gets controversial. While the Dow was partying, the S&P 500 barely budged, inching up a measly 0.22 points, or 0.003%, to 6,735.35, a testament to the mixed feelings in the market. And the tech-heavy Nasdaq Composite actually fell by 36.87 points, 0.16%, to 22,953.67. Ouch! A major culprit was Netflix, which plunged 6.5% in after-hours trading after missing its earnings target due to a significant tax expense in Brazil. This highlights the vulnerability of even the biggest tech companies to unexpected setbacks. The Fed factor. A pause with a price. Adding to the uncertainty is the Federal Reserve's, the Fed, stance on interest rates. The Fed's hints at a possible pause in rate hikes have sparked cautious optimism, as lower rates generally boost economic growth. But this pause also introduces volatility, particularly in tech and small-cap stocks, which are more sensitive to interest rate changes. It's a delicate balancing act, and any misstep by the Fed could send the market into a tailspin. Across the pond, Europe's cautious cheer. European markets mirrored the mixed sentiment, with the pan-European Euro Stoxx 600 edging up 0.21% to 573.30. Germany's DAX index rose 0.29%, while France's CAC 40 gained 0.64%, and London's FTSE 100 saw a modest 0.25% increase. Defense and aerospace companies like Airbus and Safran soared, riding a wave of positive U.S. aerospace earnings. Luxury brands like Hermès, Ferrari, and LVMH also enjoyed gains, fueled by margin optimism and strong demand. However, mining stocks struggled due to falling precious metals prices, slightly dampening the overall enthusiasm. East meets West, Asia's uneven performance. Asian markets presented an even more complex picture. Japan's Nikkei 225 saw a slight decrease, closing at 49,371 points, down 59.94 points, or 0.09%. And this is the part most people miss. Despite optimism surrounding potential easing of U.S.-China trade tensions, the Hang Seng Index in Hong Kong fell by 1.05%. Mainland China's Shanghai Composite and Shenzhen Component Indexes also declined, as disappointing Q3 GDP data fueled expectations for more stimulus measures. South Korea's benchmark index bucked the trend, rising marginally thanks to gains in semiconductor and tech stocks. Meanwhile, in Australia, the SP/ASX 200 dropped, reflecting global caution amid mixed signals on inflation and central bank policies. What does it all mean? So what's the takeaway from all this market activity? It's a mixed bag, to say the least. Strong earnings are providing a boost, but concerns about valuations, interest rates, and global economic uncertainties are keeping investors on edge. Volatility is likely to remain a constant companion in the near term. The key question is, are we heading for a correction, or will the market continue its upward trajectory? Some argue that the market is overvalued and due for a pullback. Others believe that the underlying economic fundamentals are strong enough to support further gains. And this is where the discussion gets interesting. Is the market's resilience a sign of genuine strength, or are we simply in a bubble waiting to burst? What are your thoughts? Do you think the recent earnings reports justify the current valuations, or are we setting ourselves up for a fall? Share your opinions in the comments below.